What is a portable mortgage? Most mortgage lenders in Canada will allow you to port your mortgage from one property to another. For example, if you own a property and purchase another with the intention of selling your current property, porting your mortgage could be an option. Why would you want to port your mortgage? One reason would be when you port a mortgage, you avoid having to pay a penalty since you are not breaking the mortgage. Another reason would be if rates are higher than the rate of your mortgage at the time you are selling your home and purchasing another, porting will allow you to avoid having to take a higher rate on your mortgage. Now, a common question is, what if you need to increase the mortgage in order to purchase a more expensive property than the property you are selling? Well, this can be done with a port, blend, and increase. This is where the existing mortgage is ported, and the lender then increases the mortgage to the required amount by using a blended rate. With a port, as well as a port, blend, and increase, the amortization must remain the same as the current amortization of the mortgage being ported. This can affect the borrower's ability to qualify for a large enough mortgage as required. So basically, the lower the amortization is on a specific amount of mortgage, the more income is needed to qualify for that amount of mortgage. The maturity date of the ported mortgage, as well as that of a ported mortgage with a blend and increase, must remain the same as the mortgage being ported. So let's say that you're porting the exact amount of the mortgage that you have on the current residence over to the new property. Basically, that means the mortgage is completely unchanged. Everything stays the same. But if you do a port, blend, and increase, the term, let's say there's 2.5 years left, must remain at 2.5 years. And you can see my video on blended rates just to see more information on how that's done. One thing to remember is if you own an existing home and you pay default insurance on the mortgage when you purchased it, that default insurance is portable. If the mortgage being ported is default insured and it is blended and increased, if default insurance is still required on the mortgage, the borrower can pay a top-up premium on the default insurance rather than having to insure the entire mortgage. So what is an assumable mortgage? Most lenders in Canada will allow a qualified borrower to assume an existing borrower's mortgage. Some lenders will allow a blended increase on the assumed mortgage if the mortgage is not large enough as required to complete the purchase. Let's say you're assuming a mortgage and you have a 20% down payment, but the mortgage on the existing property is only 70% of the purchase price. In that case, you would need a blend and increase to the mortgage. What are some of the benefits to assuming a mortgage? Well, if you're selling your home without the intention of purchasing another, let's say, for instance, you've been stationed overseas or something like that, and the rate of your mortgage is lower than the rates available at the time of the sale, the buyer could benefit from the lower rate, and by providing your mortgage to the buyer, you're not charged a penalty since the mortgage is not broken. This could be handy for instance, like I said, if you're stationed overseas and you're with the military and you own a home and you're going to a different country and you're not going to buy another home in Canada, or you have the type of job where you live out of the country for longer periods of time. This is where we see this used. Also, a mortgage with a lower rate than the rates available at the time of the sale could attract buyers and increase profit for the seller. For example, if the current mortgage will save the buyer $4,000 in interest if assumed, the two parties could split the difference by increasing the purchase price by $2,000, which would increase the profit for the seller by $2,000 and save the buyer $2,000 in interest. So this would require a calculation between the rate of the mortgage being assumed versus the higher rate that the buyer has approved with their lender to see what the difference in interest will be over the term. Mortgage assumption can also be a tool used for estate planning purposes. For example, in the event of death, the party inheriting the home can assume the existing mortgage and avoid having to pay a penalty. In this case, they would assume the mortgage from the estate of the deceased. Well, I hope that covers everything. If I missed anything or you have any questions for me, please feel free to leave them in the comment section below.